Very good afternoon, dear students and viewers. I welcome you to today's session on business mathematics, logical reasoning and statistics. Today's topic is on time value of money, part 2. First of all, thanks for all the queries. We have received 205 queries and we have filtered them. I will be responding to them shortly. We shall be revising calculator tricks. Some of you have requested me to revise. Second is we will focus on what we discussed on the last day, that is on time value of money, day 1, simple interest, compound interest, and we shall move into the effective rate of interest, and we shall now, today in fact, we shall be learning something which is totally new for many of us, and that is annuity payments. Then we shall move on to future value, present value, and the concept of sinking fund. Then we will move on to some of the revisions for inequalities, matrices, Cramer's rule and solving equations. So that is the agenda for today, the 13th of July, and a fresh week has started. So let's renew our efforts and move on to today's discussion. First of all, in terms of the calculator tricks or the shortcuts for using calculators, once again I am repeating because many of you are sending queries. Please note that only 12-digit normal calculators will be allowed. Scientific calculator will not be allowed for exam purposes. And for repeated calculation, I'll be sharing 3 or 4 shortcuts for repeated calculation. Multiplications or divisions. Whatever mathematical operation you want to undertake, if you press the symbol twice, say you are adding, if you press it twice, or if you are dividing, if you press it twice, then a factor, or sort of a resultant k will appear on your screen, on the calculator screen. So this saves a lot of time during exams for repeated calculations. The second one is the use of gross total. In your calculator, you must have seen there is a symbol for gross total. Now for gross total, what happens? Say I am giving some examples of calculations. The first calculation you have done is 10 plus 20. So using calculator, 10 plus 20, okay, equals 30, fine. Next, you are doing a multiplication. So 30 into 2 is the calculator will add up all these 3. So 30 plus 60 plus 20, so you get 100. So you will get 100. So this is how, if you see, you will be able to, 110, yes. If you are using calculator, scientific, non-scientific calculator, you can easily use the GT or the gross total and you will be able to make a shortcut. This will save your time to a large extent in the exam. The third one is using memory operations. Now, if you look at the calculator which we are using, you will find there are 3 buttons. You have the M plus button, you have M minus button, and you have something called MRC. Now, MRC is basically for the memory recall. The short form of recall is RC. So, memory recall is RC. Now, say here again we are doing number of calculations for a particular problem, typically like time value of money or like say permutation combinations or say probability where there are multiple calculations, right? It could be matrix also because in matrices we have seen a series of calculations, especially if you are asked a question, find out the inverse of a matrix, then you need to find out the determinant, you need to identify the cofactors, from the cofactors you go to the adjoint and thereafter from the adjoint you can arrive at the value of the inverse of a matrix. So it involves number of series of operations, right? But if you are following this M plus, M minus and MRC buttons, and if you use it judiciously in an intelligent manner, then to a large extent your efforts can be minimized. Now I'm giving some example, 10 plus 30. So I'm working on a calculator, 10 plus 30 gives me 40. Now I want to add this 40. Later on, I want to add this. So I will press M plus. Next calculation I am doing 100 minus 50. This is 50. This number I also later want to add. So I have a formula where I have to add, say, A, B, C, D. I'm writing these A, B, C, D. I have to add A plus B. So this 50 also I will use M plus. Now I am doing the third calculation, 30 minus 10. Or say let's do 30 minus 20 equals 10. 30 minus 20 equals 10. This I want to subtract. So say the formula is A plus B minus C. So 30 minus 20 is 10. And I will press M minus button because this I want to subtract. Okay? M minus. The fourth calculation I am doing, 20 plus 30 equal to 50. This also I want to subtract. So the formula which I am working upon is A plus B minus C minus D. So this 50 also goes into M minus. So now, after you have completed all these four, so as I was saying, dear friends, that in case of determinants, in case of matrices, also in case of simultaneous equations, quadratic equations, cubic equations, the ones we have completed, extensive use of the calculator has to be done in the exam, keeping in view the time constraints and keeping in view, of course, the time which is to be allotted for each and every question. So fast, quick use of the calculator using the shortcuts has to be carried out, and this is one way. So first formula is 10 plus 30. The first, the calculation is 10 plus 30 equals 40. This is A. B is 100 minus 50 equals 50. C is 30 minus 20 equals 10. And D is 20 plus 30 equals 50. So we have got A, B, C, D. And I am working on the formula A plus B minus C minus D. So the moment I have entered all these, 40 is going into M plus because I am pressing M plus. After 50, I am pressing M plus again. After 10, I am pressing M minus because this 10 is C and C has to be subtracted. Again 50, which is D is 50 and D has to be subtracted. So I press M minus. After this, the moment I press final MRC, automatically the calculator will work on this. So it will do 40 plus 50 minus 10 minus 50. So we shall be getting the desired answer of 30. The final answer is 30 because 40 plus 50 minus 10 minus 50 gives us 30. So the calculator will do it. So this is the third shortcut, and many of you have asked questions in the query column in the chat box regarding the use of calculator and the memory function. The last one, dear friends, is when you need to multiply. Now for indices, especially, okay, for indices we have seen you need to multiply. Also, for this particular case of time value of money, I think there are cases where you have to find out, say, we know the time value of money formula for compounding. So we know A is equal to P into 1 plus I to the power N. Now if N is 15, so the number of years is 15. So what do? You have to multiply, go on multiplying 15 times. Yes, it takes time. So now, say I want to multiply 20 into 20. So the shortcut is, you press 20, okay, and then you press on the multiplication sign. Okay, you don't have to type the second 20 digit. Just type 20, just press in 20, key in the 20, then multiplication, and then if you press the equal to sign, automatically it will give you 400. So I press 20, multiplication sign, and then equal to sign, it directly gives me 400. I don't have to enter 20 again. So this is another shortcut which we use, and this will be useful in your exams, especially under tough conditions when you have to utilize each and every second for solving your problems. Friends, I also want to share two very important websites here. The first one I talked about is ICAI.org. The first one. The second one, you will be surprised to know that our Institute of Chartered Accountants of India has a separate website for exams. And the website is ICAI exam.icai.org. So it is icaiexam.icai.org, and there, if you go to this website, a very important document is there. It is a 21-page document, especially on the information and the guidance for those people who are appearing for the exams. So it contains detailed discussion guidelines for those examinees who are appearing for the CA exam. I saw it just 2 days back, so I thought of sharing it through this excellent platform which Institute has arranged, the virtual coaching classes. Please go through this. And also you will find in this particular website the FAQ. You will be getting the FAQ, the frequently asked questions relating to admit cards and other essential part of the CA exam. So please keep a note of this website, icaiexam.icai.org. Also, many of you are asking through the queries that, sir, we have not received the study materials. I am not having the books. How do I study? Two solutions. First is, please download the study materials from ICAI.org. Please go to Board of Studies Knowledge Portal. From there, please download the respective study materials for all the 4 subjects. Plus, you will be getting the model test papers, MTP, for the May 2020 term. Second alternative is, there is another website that is ICAI-CDS.org. CDS, ICAI-CDS.org. So if you want to get hard copies of your study materials, you can order it online here, and you will be getting the foundation revised study kit. Also, you may be getting past year's question papers, because many of you are asking about past year's question papers. You may be getting some of these questions also. I'm not very sure. Please check this particular site. You will get further information. Okay. So now, friends, we move on to today's discussion. I thought of sharing these information as part of our initial discussion. Now we move on to the technical discussion for the day. And last day, if you remember, on the 11th of July, we discussed about the concept of simple interest, why interest is paid, what is compound interest, the difference between simple and compound interest, and then we moved on to understand number of applications, number of numericals from the study material. Today we are going for a quick recap of those areas, because some of you wrote in the queries that you requested me to cover certain areas once again for your understanding. Then we shall move on today to annuity. Annuity means a fixed payment of money over a period of time, every month, every quarter, every year, right? So it's a fixed amount of money. We shall learn that there are 2 types of annuities today, annuity regular and annuity immediate. Then we will move into the concept of present value, future value, and calculation of returns. That is what we shall be doing today. This is day 2 of time value of money. And on the 3rd day, we shall start with leasing, with bonds, with capital expenditure, and compounded annual growth rate, CAGR. And we shall be winding up this chapter. Now, first is time value of money. Let's recap what we did on the last day. Now, time value of money, you can understand, is basically the fact that value of money changes over a period of time. A money received in future is not as attractive as the money which we receive today. Because if I receive money today, I can reinvest, right? I can reinvest that money. I can invest that money, and investing means I get some returns. So money received today is much better than the same amount of money which I am receiving tomorrow. Now I have 3 young friends who are our viewers, our students who have raised questions here. Prachi Gupta from Chandigarh, Savi Mangla from Gangtok, and Sumit Kalra from Bhopal. Now they have asked the question whether time value of money chapter, from this chapter, do we get theory questions in the exam? Well, till now I have seen very few theory questions. In fact, maybe 98% questions are practical questions. But whatever theory we have discussed and we are going to discuss today is important for you, because if you don't understand the theory part, it will be difficult for you to memorize the formula and to apply them in the numericals which will be asked in the exam. So the theory is important, even though Very rarely the theory comes from this particular chapter. Okay, now 4.2, page 4.2 of your study material, quickly we again see why interest is paid. I was discussing about the time value of money, the opportunity cost. What is opportunity cost? Opportunity cost is the return I could have obtained if I had used the resource for an alternative purpose. So you have a house, you want to put it on rent, or you want to use it for business, right? And if you had put it on rent, maybe you could have got 20,000 rupees per month. So if you want to put it as capital in your business, or if you want to just run your business by utilizing your house, your opportunity cost is 20,000 rupees per month, because that is what you could have earned if you had put that house on rent. So putting your house on rent, giving it on rent, or giving it on lease means that you are putting your resource, your asset, in an alternate way to earn some returns. Okay. Now there's a question of inflation. I discussed about inflation the last day. Inflation means the gradual increase in the cost of everything, right from food items to consumer durables to car, automobile, services, everything. So increase in prices, the general increase in price over a period of time is defined as inflation. You can understand, if my salary remains the same, but inflation goes up, right? What happens? My savings become less. Say last year my salary was 10,000 rupees per month. This year also my salary has not increased because of COVID, because of say the lockdown. My company is not making money. They are not earning. So they have kept my salary at 10,000. But the prices of the commodities, from food items to dressing to recharging your mobile, everything is going up. Services, the entire cost is going up. So what will happen to my purchasing power? My purchasing power goes down. So as inflation goes up, I've given an upward arrow. What happens is the purchasing power, PP, purchasing power goes down. That means I will not be able to purchase. My consumption goes down. That is the effect of inflation. Now, there's one of our friends, Tanu Tanwar from Faridabad, who has asked a question. So what is the difference between taking an asset on lease and on rent? I was just talking about giving your building on rent or putting it for business. Now, lease and rent are almost the same. The only difference is normally for rent, we consider 11 months as a standard period for giving anything on rent, your house, your premises, right? But for lease, when we use the term lease denotes a longer span of time. Sometimes land is leased out for a period of 99 years. Just imagine, almost a century, 99 years. So the period of lease is much more than the period of rent. Also, please remember, since Tanu has raised the question, I thought of sharing this because this might answer many of your queries. Many of you may have a similar question, that what can be the difference between lease and rent? Okay, so lease, of course, as I said, the standard term, the standard duration of lease is longer than that of rent. And second is, lease can be of two types. First, what we call is operational lease, which is very similar to rent. I am just getting the right to use an asset for a periodical payment. It can be a monthly lease rental. It can be a quarterly lease payment. It could be an annual lease payment. But after the end of the lease period, the asset will never become my asset. It will be the asset of the lessor, the person who has given it to me on lease. So the property in that asset will not come back to me. This is operational lease. Okay. What is the other type of lease? The second type of lease is called finance lease. Finance lease means a lease where I enjoy the use of the asset. I use the asset for a periodical sum of money. I pay monthly rent. I pay quarterly lease rental. I might be paying annual lease rental. But at the end of the life of the lease, maybe the lease is for 10 years. Maybe the lease is for 7 years. After the lease period is over, the property in the asset comes back to me. So I acquire the rights, the risks and rewards, and the ownership of that property. Now, when you take a loan to buy a car. When you take a loan to buy a house, you pay EMIs, right? We always use the word EMI, equated monthly installment. If you ever see the EMI chart, the EMI statement from your bank, you will see that every month EMI is broken into two things, principal and interest. So if I'm paying an EMI of 8,000 rupees, say for a car which I have purchased, EMI of 8,000 rupees per month, because I have purchased a car, what happens out of this 8,000 rupees of EMI, maybe 4,000 or 5,000 rupees goes towards the repayment of the interest, and maybe 1,000 rupees or 2,000 rupees goes towards the repayment of the principal. Right? So the EMI is split into the principal repayment portion and the interest repayment portion. Right? Please also remember that when we talk of lease, there are two very important accounting standards. Now, when we talk of rent, is there any accounting standard on rent? No. Is there any accounting standard on lease? Yes. Accounting standard 19 issued by ICAI deals with lease. Okay? So it talks about the accounting treatment of leasing transaction. Okay. And you might be knowing in your accounts, you must have heard about a new type of standard, which is called Indian Accounting Standard. Ind AS. Right? Under Ind AS, a very recently introduced Ind AS 116. Okay. This talks about lease. So I hope I'm able to explain what is the difference between rent and lease, because these two words are often used interchangeably and many times we really don't understand the real meaning of the difference between these two terms. Okay, so this is what is rent and what is lease. Now we move on to inflation. So as I said, inflation means the general increase in the price of commodities, and the fact that as inflation increases, please keep a note, as inflation increases, what happens is the purchasing power of common man falls. Secondly, inflation means today's money will not buy the same things tomorrow. I'm taking an example. Okay, I'm drawing actual figures, actual data. 1990. Okay, before you were born. Most of you were born, after 1990. 1990 and let us take 2017. Okay. Petrol price. So I'm writing number 1. 1 liter of petrol. Okay. Something which everybody uses either directly or indirectly. Even if you don't use a car or a motorcycle, you are indirectly using petrol, because when you go to buy something from the market, you are indirectly paying for the transportation cost. So if cost of petrol goes up, yes, you have to pay more for getting the same quantity of petrol, or if you go to the market to buy something, you have to shell out more. So petrol is something of a commodity which we use every day. Now in 1990, the petrol price was rupees 10 per liter, approximately. And in 2017, it became somewhere around 66 rupees. So rupees 10 was in 1990 and 66 rupees in 2017. So you can see the same quantity of petrol, but how expensive it has become. And this, if you calculate CAGR, the compounded annual growth rate, the average growth in the price of petrol per year, it comes to almost 8%. This is the first example of inflation, right? The second inflation example is we are taking a liter of milk. So 1 liter of milk. In 1990, the price was somewhere around rupees 6. And in 2017, 1 liter of milk is costing somewhere around rupees 40 to 42. Good quality milk. So if you look at the CAGR here, it comes to, yes, almost 8.19% is the CAGR. So you can see same quantity, but in 1990 price was 6 and in 2017 in a span of 27 years, the price has gone up by almost 7 times, right? So this is inflation. The last example is something we eat every day. Chapatis, right? Roti. So atta, something we use every day. 1 kg of atta, right? In 1990 was costing somewhere around 5 rupees to 6 rupees. And in 2017, it was costing around 27 rupees. 27 rupees. 1 kg of atta. This shows a CAGR of almost 7.7%. So you can see this is inflation, the general increase in prices. So you can understand that when I take a bank loan or when I take a amount of money as a loan from someone, why I pay interest? Because he is giving me 10,000 rupees for 5 years. I will repay him 10,000 rupees. But when I repay him the 10,000 rupees after 5 years, the value of 10,000 rupees has gone down. So I must pay something additional to him. I must pay something extra to him, which will compensate him. Okay? You understand what is compensation? Indemnifying somebody. Making good the loss which I have created. That is why we pay interest, because you can see 10 rupees has become 66. That means if the price of 1 liter of petrol has gone up by almost 7 times, can I say, in other words, that if the cost has gone up by 7 times, can I say that the value of money has fallen by 7 times? Because I am buying the same quantity. The product is same, the quantity is same, right? But I am paying almost 7 times. That means the purchasing power of money has fallen, right? This is what is called inflation. I hope this is now very clear to you. Another example, why we need to pay interest, you will understand. I'll take a small example. Now, it's a very small, calculation. Say I have rupees 1 lakh in a bank. I have put money in a bank. I have kept it in a savings account. So savings bank, 1 lakh rupees. Fine. You know, normally savings bank account, the interest which banks offer is around 4%. But now due to lockdown, due to this loss of business, due to the pandemic COVID-19, you can see banks are not doing good business. So they are offering around 3%, right? So let us assume they are offering an interest of 4%, which is the normal rate. Now savings bank is 1 lakh I have kept. The interest I earn in 1 year is 4% of 1 lakh. You know, we have discussed the equation, the formula for simple interest, principal into interest rate into time. Here the principal is 1 lakh. Interest rate is 4% and the time is 1 year. So I end up getting 4,000. Fine. This is added. Fine. But on this 4,000, I have to pay a tax. Maybe some of you have heard there is something called TDS. Tax deducted at source. Tax deduction. The bank will deduct tax. And normally the bank deducts 10% tax on these type of payments, interest payments. So 10% of 4,000 means 400 is gone. So minus 400. Now, we have seen that on an average, the inflation is around 6%. That means last year to buy something, if I had paid 100 rupees, this year I have to pay 6% more. That is, I have to pay 106 rupees. So there's an increase in inflation by 6 rupees. So I will write here that impact of inflation. Impact of inflation is 6,000. And this is minus because inflation means my purchasing power has gone down, right? So if you see, I started with 1 lakh, okay, plus 4,000, but this is minus. And this is minus. So if you see, I end up the amount of money, the value, I'll put in this way, the value of that 1 lakh at the end of the year is somewhere around 97,600. 1 lakh plus 4,000 minus 6,000 minus 400. 97,600 is the approximate value. So I hope you can understand that if the bank is paying me interest, I had 1 lakh rupees, but after 1 year, even though I have earned interest, in spite of that, the value has gone down. I started with 1 lakh, now it is 97,600. Right? I have to pay tax of 10% and I have got interest of 4%. So you understand, 4% interest is not enough. I at least need to earn more than the inflation. If the inflation is 6%, the interest which I will earn or I should earn should be at least 7 to 8%. So that after paying the tax and after covering the inflation, I have something extra. If the return I am getting, here the return is 4%. If the return I am getting is less than the inflation rate, or if it is equal to the inflation rate, then I am not earning anything. The value at the end of the year will go below the value I had at the beginning of the year. Right? I hope this is now clear to all of us. Right? So in this way, if you see the study material, the institute has given a very nice formula. I'm writing it. Please see that in the study material also in this chapter. Now, I was talking about return. If you see the study material, a small formula is there based on which many numericals are coming in the exam. The formula is that real return is equal to the return from the investment minus the inflation rate. Please note this. Please kindly note this. Very important for you. Real return, the actual return I am making is the return from the investment minus the inflation rate. So, if the inflation rate is 6% and if I am earning a rate of 9% on a mutual fund, say I have invested money in shares or in a mutual fund and I am earning a return of 9%. So my real return is 9 minus 6, that is 3%. Please remember this because this is an important part of the chapter time value of money. This concept is very important and this is a very important formula. If you see the general trend of inflation in the last maybe 10 years is that inflation is between 6 to 8% per year, which means that year after year, the prices are increasing. Prices of general commodities are increasing by a margin of 6% to 8%, right? So it is 6% to 8% is the average increase in the inflation. I hope now it is clear to all of you. I'll take some questions here and our friend from Assam, we have a friend who is one of our students and is part of the LBC, the virtual classes, Arnav Bajaj from Assam. Now, he has asked the question, sir, is inflation good for the economy? Now, we have seen what is inflation. My answer is, little inflation is good for the economy because as the inflation goes up, the demand goes up. However, the demand and supply needs to balance. You all know that if you talk about a curve, right, normally this is the shape of the demand curve, DD, and supply curve is SS. So, finally, we have to reach an equilibrium. Too much of demand is not good. Too much of supply is not good. So too much of inflation is not good. Again, too little inflation is not good. The Reserve Bank of India and the Ministry of Finance, they continuously work together so that they can control the inflation and they can optimize. I use the word optimize. Okay? They try to have the appropriate inflation. They try to control inflation in an optimizing manner. Right? There are different techniques of that, like repo rate and reverse repo rate and bank rate. I'm not going into it now. Second question is, yes, it is also true that as inflation goes up, purchasing power comes down and the interest rate also moves up. Next question from Madhusudan Kabra from Rajasthan. What is the relation of inflation with money? He has asked the question, Madhusudan. Thanks to Madhusudan and Arnav for asking the question. What is the relation of inflation with money? Now, inflation, the answer is, as we saw right now, as inflation goes up, the purchasing power comes down. So I will put it in this way once again, answering your question, and I'm sure many of you have similar question. As inflation as inflation goes up, the purchasing power comes down, and the money circulation, if I use less of money, as prices go up, I will try to control my consumption. I will say that, oh, no, I won't eat outside. I won't go for holidays. I won't buy a new mobile. Things are going up. Prices are going up. I will not go out for traveling. So what will happen? The money circulation, okay, it will come down. So two impact of inflation: as inflation goes up, our purchasing power comes down and the money circulation also comes down. Okay, the last question is from Kanika Mehta from Hoshangabad. Kanika Mehta from Hoshangabad, I hope you are all there today. Please explain the impact of inflation. I hope you have got your answer, Kanika. Inflation has two direct impacts. First is, little bit of inflation is good for the economy. Inflation, as it increases, the purchasing power of money falls. And second is, as inflation increases, the money circulation also gets adversely affected. Hope it's clear now. Okay. We also saw on the last day the difference of simple interest and compound interest. I took a table to show you the difference in calculation with a sum of 1 lakh rupees. What is the difference in the simple interest part and the compound interest? I also discussed details about the fact that compound interest means interest on interest. Simple interest, we have seen that it is principal into interest rate into time. But in case of compound interest, you saw that the amount is equal to principal into 1 plus I to the power n, where I is the interest rate and n is the number of conversion period. I hope you have kept a note of this. You may remember that we solved number of numericals also. Now a very important, I will say a very important formula which you have to remember, right? Shortcut. So it's a shortcut also. So this will be interesting for many of you. Shortcut. If you are given a question that find out the difference in the simple interest rate, simple interest and the compound interest for a given amount of money, say the amount of money is 10,000. You know that the interest rate is given, it is say 6%. Now they ask you that what is the difference in the simple interest and the compound interest on this particular sum of money for a period of 2 years. There's a formula, a shortcut. So I'm writing the formula here. Okay, there are two formula. One is for 2 years and the other is for 3 years. Okay, and here I am writing, this is the difference of compound interest and simple interest. Difference. You know that compound interest for a period of time will always be more than the simple interest, because in case of compound interest, you know, I have discussed in the last class, please recall, in the last class we discussed that the basic difference between compound interest and savings and normal interest, simple interest, is that in case of simple interest, the amount of principal remains the same. But in case of compound interest, the principal amount increases. Why? Because when I am earning compound interest, the interest is added to the principal. So it is now merged. In the second period, the new interest will be calculated on this one, that is on the principal and interest which is added. Right? So the principal increases slowly. Since the principal increases slowly, the interest on the principal also increases. So the compound interest will always be more than the simple interest, and the formula is very important. Please note, for 2 years, the formula is P into I square. Right? Very important formula, where P is the principal and I is the interest rate. This is very important. It is given in the study material. Thanks to the Institute of Chartered Accountants of India for including this formula in our study material. Very useful shortcut for calculating the difference between the compound interest and the simple interest, where P and I are given. Similarly, for 3 years, the formula is, that means if the question is, find out the difference between the compound interest and simple interest calculation on a given amount of money for 3 years, right? The formula is 3pi square plus pi cube. Okay, so it is 3 into pi square plus p into I cube, where p is the principal and I is the interest rate. So it is a very, very important, I will say very, very important shortcut which you should remember, and we shall also use this shortcut in different numericals which we are going to do today. So please write these two down in your notebook, in your notepad, so that you don't forget this. So we saw the formula P equal to, the interest is equal to principal into interest into time. In case of, this is the first formula. In case of compound interest, we saw that the amount is equal to the principal multiplied by 1 plus I to the power n. This is the second formula. This is the third formula. The difference between the compound interest and the simple interest for a period of 2 years, when we know that P is the principal and I is the interest rate, right? So it is P into I square. And for 3 years, the difference between compound interest on a given sum of money and the simple interest on the same sum of money is 3 pi square plus pi cube. Very important. Okay. Now we proceed to another important part, and that is, I hope you have noted this formula. Now we move on to the other important part, next one, that is risk and interest. Now I discussed that as risk goes up, interest also goes up. In fact, we always write interest is equal to base rate plus risk premium. You will learn this later on, but I'm just sharing it now. It will help you for the time being, that more the risk, more is the interest rate. There are two companies. Now you know company A and company B, for example, they are approaching a bank for a loan of 100 crore. Company A is very well known. The management of the company is very strong. Company A's share price is high. Company A has a high credit rating. It has a AAA credit rating. Company B has a low share price. Company B's credit rating is BB minus. And company B's management is not very good. Okay, the interest rate for the same amount of money will be different for these two companies, because in this case, going by what I said, company B is more risky. The risk is more. So, if company A has to pay an interest of say 11% on the loan, company B will have to pay a higher amount of risk premium because it is more risky. So maybe company B has to pay 11 plus 1.5 risk premium, so 12.5%. Okay, so you can see as risk increases, the interest also increases, right? Interest rate also increases. Okay, there was one more question from Tushar Datta from Jharkhand. Liquidity and interest. What is the relation between liquidity and interest? Well, why we pay interest? Why we receive interest on our bank fixed deposit? Why do we get returns on mutual funds? Why? Because we have kept the money blocked in the fixed deposit. We have kept the money blocked in the mutual fund. When they pay us interest, usually the interest is in the form of cash. That is, it comes by check. It could be a direct transfer to your savings account. It could be a direct cash transfer. It could be a direct fund transfer, direct credit, which means it provides you with liquidity. Okay, so therefore interest repayment is a form of liquid payment, and everybody wants liquidity. You can understand during the days of lockdown, during the days of the pandemic, every household is thinking, do I have enough money in liquid form? First of all, am I earning enough? That is a big question. And second is, do I have enough liquid money to pay for the day-to-day expenses? Friends, you know the importance of liquidity. If you see your accounts, you have read about current assets and current liabilities, and you know there is something called asset test ratio or current ratio. You might be knowing asset test ratio, also called quick ratio. So that ratio is computed to find out the liquidity. This is the relation of liquidity with interest. Okay. Now there was a question again on conversion, because we will be doing number of numericals and we are doing quick revision, and you see the revision is like this. Now if I is 6%, I wrote in the last class that this is equal to 0.06. We have some friends who could not understand. Jay Pathak from MP and Shiva Sankaran from Chennai, Madhya Pradesh. From Madhya Pradesh, we have Jay Pathak and Shiva Sankaran from Chennai. He was asking how 6% is equal to 0.06. Now 6% means what? 6 by 100. And if you just divide 6 by 100, okay, you have to put, the point decimal is here, you have to go 2 zeros. So it will go to 2 places to the left. So 1 place and 1 place. So it is 0.06. Okay, so 0.06. Similarly, if I write say 12%, 12% is 0.12. If I write 5.5%, it is 0.055. Okay, so I hope it is clear. Right. Also, Latika from Sydney, our friend from Sydney. So she has asked a very important question in compounding. Now we have seen the formula. A is equal to P into 1 plus I to the power n, where n is the conversion period, and I is the interest. Okay. Now her question is, while writing the time, say if we know that 12 months equal to 1 year. So she is saying, can we write n equal to 12? Answer is no. Because if it is given that the interest is annual, if they are saying that 10% per annum, that means it is on a yearly basis. Yearly basis we will consider as 1. Conversion period will be 1 and not 12. Right? If you take 12 and 12 here, it will go haywire. If you consider monthly interest, then of course n can be 12. Okay? If there is monthly compounding, then n can be 12. It is annual compounding in this case. If it is annual compounding, then n has to be equal to 1 always. Okay. Of course, when the period is 1 year, please keep a note of that. Okay. Now, you saw that another small formula before we proceed is, we know that amount, or you can call it accumulated balance, right? This is equal to principal plus interest. So if I have a principal amount of 1,000 rupees, okay, and I earn 5% simple interest, 5% simple interest, then I am getting an interest of how much? 5% into 1 into 1,000. 5%, which means 0.05 into 1, because n is 1 year, into 1,000. So this is equal to how much? This is equal to 50 rupees. 5% of 1,000 is 50 rupees. So 50. So I get an interest of 50. So my accumulated balance becomes 1,000 plus 50, that is 1050. Now Subiksha from Tirunelveli. Subiksha, I think you are there. She asked this question, how we can get 1050 and what is accumulated balance? I think many of you had similar queries. Now it is clear. The last one is from Manpreet Kaur, who said that if I put money in a bank, in a savings account, then will I get interest? Or is it that only in fixed deposit I get interest? Well, Manpreet, for savings bank, as I said, the banks are paying an interest of 3% to 4%. But if it is a fixed deposit, the interest rate is more, maybe from 5.5 to around 7%. So this is the interest on FD and this is the interest on savings bank. Okay, so you get interest in both the cases, but in savings bank you get less interest. Okay. Now, question was, I think compound interest you have understood, and you can also note there was a question from Khushi Bharadwaj from Delhi, Nitya Anandan from Chennai, and Divesh Singla from Patiala regarding compounding. So once again, I am just going into the formula and then we will go into numericals and we will directly move into effective interest rate. So we know that the amount A is equal to principal into 1 plus interest to the power n. This is for compounding. Now it is, you know that n is the conversion period. Okay, n is the conversion period. The question is, if daily compound is given, if it's a question of daily compounding, then there's a question from Divesh Singla from Patiala. Sir, if it is daily compounding, then, and the year is a leap year, then shall we divide by 366? So if it is given that the interest rate is say 7.32%, right? And the year is 2020, which is a leap year, or 2016, which is a leap year. That means we have 366 days, and this is the per annum interest. Divesh, thanks for asking this question. Divesh Singla from Patiala, thanks for asking this question. My thanks also to Khushi Bharadwaj from Delhi, who wanted me to explain compound interest, which I've already done. And Nitya Anandan, she asked regarding the interest on the cumulative value for the 6 months. Yes, first 6 months, if the compounding is done 2 times, if n is equal to 2, if the compounding is done 2 times in a year, semi-annual compounding, and the amount involved is 100 rupees. Say I am putting 100 rupees in a bank, or let's take 1000 rupees, 1000 rupees. Interest rate is 6%. Okay? First 6 months, I'll be earning how much? 6% of 1000, but this is for the full year, so divided by 2. Okay? So it will be 6% of 1000 is how much? 60. Divide by 2, you get 30. So my interest in the first 6 months is 30. Okay? But this 30 is now added to the principal. So the new principal becomes 1030. On this 1030, for the remaining 6 months of the year, I will earn compound interest. So the calculation for the next 6 months, that is what Nitya Anandan from Chennai has asked. From the next 6 months, what will happen? The interest will be 6% of 100 into 1030. So this 1030 will come here. Okay, so you get more interest. In the first 6 months, the calculation was 6 by 100 into 1000 into half. For the next 6 months, the calculation is 6 by 100 into 1030 into half. So you get more. That was Nitya's question, right? And Divesh question is again a very interesting question, that what happens if we know that the year is a leap year, it has 366 days, and we know, say, annual interest is given. 7.32 per annum is the interest given. In this case, if it is a case of daily compounding, then I have to divide 7.32 by 366 because it's a leap year. If it is a normal year, then I will divide by 365. But it's a leap year, so I divide it by 366. In this case, if you divide by 366, you will get a particular percentage, which will be the percentage of interest on one single day, a daily interest. So this will be used for daily compounding, right? I hope all the answers are given. Now we go to another few interesting shortcuts which you need to remember and note down. Okay, so this is on compounding of interest. This is called the rule of 72, 1114 and 144, but this is only a thumb rule. Thumb rule, it is an approximate, okay, and not an exact answer. It will not give you exactly the right answer, but it will give you approximately the right answer. There's a difference between approximation and exact. The rule is very simple, that the rule of 72 says that, say for example, if you want to find out that you have an interest, you are earning an interest of 8% on a particular investment. You want to know in how many years this money will become double. The investment will become double. You have 1000 rupees. The interest rate is 8%. In how many years this 1000 rupees will become 2000? Okay? You want to double your investment. So for doubling, I am writing doubling. To double your investment, the rule is very simple. 72 divided by the interest percentage. So it is 8, which means 9 years. 72 by 8. The rule is 72 by 8, where 8 is the interest rate. If the interest rate is 6%, okay, then how many years will you take to double the investment? 72 by 6, that is 12 years. So please remember, for doubling, questions on doubling, in what time, in how many years your money will be doubled. Of course, we are compounding here, annual compounding. The interest is assumed to be compounded on an annual basis. Year-end compounding. Okay. So 72, rule of 72. Second question is 114. So we have discussed about doubling the money. What about tripling the money? I have 1,000 rupees. In how many years the money will become 3,000 where the interest rate is say 9% or say 10%. At 10% interest rate, after considering the compounding, in how many years I will be reaching 3 times the amount of original principal I had. Rule of 114 is used. Same thing, 114 divided by 10% because 10% is the interest rate. This will give me 11.4 years. And the last one is 3. So what happens if you are given a question like this, that in how many years the money will become quadruple? So in how many years it will go to 4 times? So the rule is 144. Okay, so the rule is 144, the money to quadruple the amount. Okay, so 144 by the interest rate. So if you are earning say 8% interest, and you want to know in how many years the money will become 4 times. So the formula is 144 by 8. That gives you, I think 18 years. 8 ones are 8, 18. So it gives you 18 years. 80 and 64. So 18 years. So rule of 72, please remember. Lot of shortcuts I'm discussing. Rule of 72, rule of 114 and rule of 144. Okay. And please also note a small question, a quiz question. Who discovered rule of 72? Any guesses? Anyone knows who discovered the rule of 72? It was discovered by none other than Luca Pacioli, the father of accountancy. You know that Luca Pacioli lived 500 years back from 1445 to 1514, and he was the person to discover this in this mathematical relation. So you can see mathematics and accountancy are linked. They are one and the same, which I told you. Newton's third law says to every action there is an equal and opposite reaction, and accountancy says to every debit there is an equal and opposite credit. Right? So it's all the same. Okay. So we have done simple interest, we have done compound interest, we have also talked about the difference between simple and compound interest. We have also done conversion periods. We saw daily compounding, monthly compounding, quarterly compounding, half year, semi-annual compounding and annual compounding. Today, last day we did more than 10 problems from the study material, and today I am taking up some additional problems from ICAI, from our institute's different question papers and question bank. Okay, so I'll take a few questions and then we will move into effective interest rate and annuity. Okay. First question is a sum of money. Okay, let me take this question. A sum of money doubles itself in 10 years. Right, there's a sum of money P which becomes double in 10 years. So it becomes 2P in 10 years. Okay. In how many years it will become triple? In how many years it will become triple? So in how many years it will become 3P? We don't know. Okay. So here, if you see, we know that 2P, this relation, in 10 years it becomes twice. So I know that amount is equal to principal into 1 plus I into T. Okay. Where principal, I'm writing P, but here amount is 2P. So I write 2P. 2P is equal to P into 1 plus interest rate. Interest rate is, we don't know, so we write I here. But the time is given. The time is 10 years. So I into 10. Right? So this means, let me write this part first. P 1 plus 10I. This is equal to 2P. So this side I am writing here. 2P. We know that principal is definitely cannot be 0. So P is not equal to 0. And P has to be positive. Right? So we deduct P and P. So what do we get? We get 1 plus 10I is equal to 2. 1 plus 10I equal to 2. Which means 10I is equal to 2 minus 1, that is 1. So I is equal to 1 by 10. 1 by 10 means 0.1, that is 10%. So we have got the interest rate, which is 10%. Okay. So now if you want to find out in how many years it can be 3 times. So the equation will be what? The equation I am writing here. We know it becomes twice in 10 years, right? So we have to find out in how many years it will become 3 times. So the formula will be amount is equal to 3P, and this will be equal to P into 1 plus interest rate is 10%. So 0.1 into T. T is the time which is required. So the formula is P cancels out. So you have 1 plus 0.1 T is equal to 3. Okay, this is the equation. Rubbing this part. 1 plus 0.1 T is equal to 3, which means 0.1 T is equal to 3 minus 1, that is 2. So T is equal to 2 divided by 0.1, which is 20. So the time period is 20 years. In 20 years, the amount of money can become triple, 3 times, right? So we used simple formula based on the concept of simple interest, and that is how we solved that the time period is 20 years. Very important for your exams. Okay. Now I go to a very important example, page number 4.14 of your study material. Some new problems we are doing today. Okay. So requesting you to move to page 4.14. 4.14, and the example is 16. Example 16. Okay. So what annual rate of interest compounded annually? So we have to find out I. Interest is not given. What annual rate of interest compounded annually? So it's a case of compounding and it is annual. Okay. So n is equal to 1. Compounding once a year. Conversion period is 1. Okay. What annual rate of interest compounded annually doubles an investment in 7 years, and so in 7 years the investment is doubled. It becomes double, and in the problem, I am sure you have opened the problem, it is given 2 to the power 1 by 7 is equal to 1.104090. So we are solving this problem on compound interest. So friends, you can see that it is given in 7 years. The money becomes double. And it is a case of yearly compounding. That means once every year, the interest is compounded. Interest is added with the principal once, and then in the next year, the new interest is calculated on the principal plus the first year's interest put together. Right? So the formula will be what? It's a case of doubling. So let us write, we know the formula is A is equal to P into 1 plus I to the power n, where A is the accumulated money, that is the amount, P is the principal, I is the interest rate, and n is the number of conversion periods. Right? This is clear, I think, to all of us. Now, in this case, the money is doubled. Right? The money is doubled. So we can see that since the money is doubled, right, we can write A equal to 2P, right? Initially we saw that compounding is done once a year, but since now we see 7 years, that means the money is doubled in 7 years, so here n becomes 7. It was a case of annual compounding, so I have written n equal to 1, but now it is 7 years, so it will be compounded 7 times. Every year it is compounded once. I have 7 years. So it will be compounded 7 times in these 7 years. Right? So n becomes 7. So what happens to the equation? This question is very, very important for exam. So the question is, the answer becomes A is 2P. So I write 2P is equal to P into 1 plus I. I we don't know. But we know n is equal to 7. So n it becomes 7. 2P equal to P into 1 plus I to the power 7. Okay, now we know that P is not equal to 0. P cannot be 0. P cannot be negative. right? So we divide both sides by P. So we are getting, what are we getting? 1 plus I to the power 7 is equal to 2. Okay, friends, once again, I go back to the chapter indices. You know that if 2 to the power m is equal to a, right? 2 to the power, let's put it in this way. Let me put it in this way. Let a to the power m equal to 2, right? Then m is equal to 2 to the power 1 by m. I'm not revising it anymore because already you had a chapter earlier. You must have learned it properly. If a to the, I'm just referring to the formula because that is required. If a to the power m is equal to 2, as per the law of indices, then a will be 2 to the power 1 by m. Okay. So here, 1 plus I to the power 7 is 2. Therefore, 1 plus I will become 2 to the power 1 by 7. But 2 to the power 1 by 7 is given 1.104090. So I write 1.104090. I write this. So 1 plus I is equal to this. Therefore, I is equal to 1.104090 minus 1, that is 0.104090. So this is roughly equal to how much? It is roughly equal to, we take 2 digits after decimal approximately, so this comes to 10.41, I will take 10.41%. Okay, so this is how we have followed this formula. Now, it's a case of compounding. Yes, it's a case of compounding. Is it a case of annual compounding? Yes. What is the conversion period 7? Well, we have learned a formula just few minutes back, and that is, you know, the money is becoming double. So we learned the formula of 72, multiplication by 72, right? We did it? Yes. I hope you're all there with me. So, if you're all there with me, right? So, let us do it. So, let us apply the rule of 72 here. Now, you know that here the formula is that you divide 72 by what? You divide 72 by 7. Because we have to find out at what rate of interest. We know the time. So, if you divide 72 by 7, how much does it come to? I think it comes to approximately 10.28. Okay? It comes to 10.28. So you can see it is very close to 10.4. The rule of 72, I have proved it. I hope it's now in front of you. So if you, instead of going into long calculation like this, if you want to go for a shortcut, yes, it's possible. And you just divide 72 by the number of years, 7. And straight away you get 10.28%. That is called the rule of 72, and you can see the practical demonstration of the rule, and you also can solve it. This gives you the exact answer, but for a quick approximate answer, you have 10.28, right, by using the rule of 72. Okay, we move on to page 4.15. I think this is clear. It's a very, very important question for your upcoming exam. And I would request you to understand clearly the process. I'm sure you have gone through it. You are clear with this. I proceed. Any problems, do get back to me through your queries. I'll take it up on the next day. Okay, now we go to page number 4.15. Requesting you to move to page number 4.15. Okay, and we are going to do example 20. So, example 20, page 4.15. Okay. Please open the example. Okay. Now, 16,000 rupees invested at 10% per annum, compounded semi-annually. So, let us write. As we read the question, let us write. The principal P is 16,000. Principal is the amount of money with which I start investing. So, principal is 16,000. And I invest it at 10%, so I is 10% per annum, and it is compounded semi-annually, and it amounts to, the amount is 18,522, right? We have to find the time, T we don't know. So we've got principal 16,000. The rate of interest is given 10%. The amount is 18,522, and we also know that it's a case of compounding semi-annually, right? Which means that we have to find out, in this case, we have to find out the time period of T, in what time, right? So, since it is semi-annual, okay, since it is semi-annual compounding, we have to find out the interest. Semi-annual means 6 months. 6 months. Half a year. Right? It is half of a year. 6 months. If the interest is 10% per annum, 10% for 1 year, 10% for 12 months, then for 6 months how much? For 6 months it is 10 by 2. That is 5%. Which means, now I hope you are clear, 5% means how much? 0.05. Yes. So 0.05. Okay. This is decimal. So this much we know. Now we have the formula, of course, A equal to P into 1 plus I to the power N, where N is the conversion periods, I is the interest. Okay. And here if you put in the formula here, so you have P is 16,000. So I write 16,000 into 1 plus I. I do we have? Yes, I is this. 0.05 is the value of I. So I write 0.05 to the power N. This is equal to amount A. So 18,522. This is the main formula. Please see. Keep a note of it. So 1 plus 0.05 means how much? 1 plus 0.05 is 1.05. So 1.05 to the power N is equal to 18,522 divided by 16,000. This 16,000 comes here, divided by 16,000. Okay, which is coming to roughly 1.157625. I have taken 5 digits, but for quick purposes, for exam purposes, maybe 2 to 3 places of decimal, 2 to 3 places after decimal should be reasonable. Okay, so this is what you've got. Now, if you solve this using a calculator, that 1.05, how many times multiplying 1.05 into 1.05 into 1.05, if you go on, you will find that if you go 3 times, you will reach this figure. So from this, we get N is equal to 3. Right. Now, please remember that we took semi-annual compounding. That means 6 months. And N is the number of conversion period. So 6 months is the duration for one conversion period, and we have 3 conversion periods because N is 3. So the total duration T, that is what we were supposed to find out. The total duration T is how much? 6 months into 3, that is 18 months. And 18 months means what? 1.5 years. So it's a question of 1.5 years. That is the time period which is required for this particular investment. Right? I hope this is a classic. Of course, it's a classic example given in the study material. This is page number 4.15, example 20. A superbly crafted, superbly developed example set by the Institute of Chartered Accountants for your benefit to understand this interesting chapter. Okay, now we move on to the effective rate of interest. Right, now we are all set to understand quickly effective rate of interest. In 5 minutes you will understand. Okay, I'll take an example, very simple example. I'm investing 10,000 rupees. So this is effective rate of interest. Sometimes I call it effective interest rate, EIR. It can be ERI also, effective rate of interest. So I'm writing EIR or ERI. In my normal, professional work, I frequently refer to it as EIR, effective interest rate. Okay. Now, what is the effective rate of interest or the effective interest rate? Now, let us take an amount of 10,000 rupees, right? We are investing 10,000 rupees at the rate of 6%, and compounding is semi-annual. So, 10,000 rupees. This is first 6 months. So the first part of the year. Okay. So I'm writing here first part of the year. That is 6 months. The first 6 months. Let's call it April. So May, June, July, August, September, October. Right. So it's April, May, June, July, August, September. 30th September. April to September. April to September. First 6 months. And from October till March. Okay. I am writing here the second part of the year. 6 months again. But this is from October till March. Right. The principal amount is 10,000 rupees. We have assumed, and interest rate is 6%, and the compounding is done semi-annual. That is why we have broken the year into two parts, semi-annual compounding. So what will be the process and how shall we calculate the effective rate of interest? Okay. Let us calculate together. I think we are all together, learning together, enjoying, and learning should be fun, right? Okay. Interest for the first 6 months, right? So this is my rough sheet. This is my final sheet. Okay. Rough sheet for the scratch pad. We call it scratch pad. So 1,000, we have taken 10,000, fine. 6%. So into 6 by 100. And for the first half year, so I can write 6 by 12 because there are 12 months in a year and we are considering for the first 6 months. Now this works out to 300 rupees. So I write 300 rupees. This is my interest, 300. Now after 6 months is over, there is a compounding because it is a case of semi-annual compounding. Now I started with 10,000, but on 30th of September, once this first 6 month period is over, on 30th of September, what happens? The interest which I have earned, this 300 will be added to the principal. So it becomes 10,000 plus 300, it becomes 10,300. Okay. Now for the next 6 months, okay, for the second part, October to March, let us calculate the interest. And this time the principal has become 10,300. So the interest on the new principal of 10,300 for the next 6 months, that is from October to March, will be how much? 6%, 6 by 100 into 6 by 12 because 6 months and 12 months into 10,300 because the new principal is 10,300. If you work it out, it comes to, this is half, okay, so this is gone, 2 into 3, this comes to 309 rupees, 309, so 309. Dear friends, please look at this surprising case. First 6 months, it is 300 rupees. Second 6 months, my interest is 309. So, in total, I have earned 300 and 309. So 309 rupees in the second part from October to March. And this 300 in the first part, April to September, if you add these two, you get 609. So the total interest I have earned is 609 and my overall principal, if you see, the total interest is 609. Now, my overall principal was 10,000 rupees. So my effective rate of interest is how much? Is 609 by 10,000. Of course, and this comes to 0.0609, which is 6.09%. Okay. So there are 4 zeros, 1, 2, 3, 4. So when you divide 609 by 10,000, the decimal is here, 609 after 609. So it moves 4 places to the left. So 1, 2, 3 and 4. So a 0 comes here. So it's 0.0609, which is 6.09%. This is the effective interest rate which I have earned on 10,000 rupees with a monthly, with a half yearly or a 6 monthly compounding system. Okay, I hope this is now clear to you and you have understood the concept of the effective rate of interest. Okay, now the formula. You have to remember this. I hope the understanding is clear and we have to remember the formula. Okay, you get number of numericals on effective rate of interest. So it is important to note this formula. I request you to keep a note of it and not to forget. The effective rate of interest E is given by the formula 1 plus I to the power n minus 1. Okay, where I is the rate of interest. In the last example, we saw that the rate of interest was 6%, right? So this is what we have to keep in mind when we are trying to compute the formula, and ultimately this will be useful for you. E is equal to 1 plus I to the power n minus 1. Okay. Next is we go to the concept of future value. Okay. So we have seen the formula for compound interest. A is equal to P into 1 plus I to the power n. Okay. Where P is the principal, I is the interest and n is the number of conversion period. So if you see, if I have, now we slowly go to the concept of annuity now. Okay, so effective rate of interest is over. We have done a quick revision of many questions which many of you were asking. I answered the questions on this chapter, time value of money, explaining inflation once again, interest, liquidity preference, right, whether inflation is good for us. I took number of examples, then we solved some additional questions from question bank and from the ICAI's question papers. And now we have just gone through the very interesting concept of effective rate of interest. Now we are starting with annuities. Very important question. What is annuity? Annuity means, say, I have invested some money in some mutual fund or in some bond, right? Bond, you know, is a fixed interest financial instrument. So maybe I have invested rupees 1 lakh in some bond, in a corporate bond, and they have said that yes, we are going to pay you interest at the rate of 7% per annum for the next 5 years, after which we will repay your principal. Okay? So for the next 5 years or for the next 7 years, whatever be the life of the bond, I will be receiving a fixed amount of money, which is the interest on that 1 lakh rupees. I have invested 1 lakh. They have promised me an interest of 7%. So I'll be earning 7% of 1 lakh. That is 7,000 rupees, right? Over the life of the bond. It can be 5 years, 6 years, 7 years, 8 years, whatever. This fixed amount of money, which I am earning every year for the life of the bond, is an example of annuity. This is called annuity. A fixed income of money either received or paid for a specific number of years. Every year the payment should take place, or every year the money should be received. The same money, same amount of money. That is called an annuity. Right. Now the question is, what is the formula for annuity? Very simple. If you are paying an amount of, say, let's take simple example, cash flow, CF, particular amount. It can be X, Y, 10,000, 20,000, 5 lakhs, whatever. So in general, the formula is very simple, that the future value, FV, the future value, like in case of compound interest, we use the term amount. In this case, we are using future value. Future value is a very simple formula, CF into 1 plus I to the power n. So it is the same formula. Please see, this and this are the same identical formula. In the case of compound interest, we had amount is equal to principal into 1 plus I to the power n. Then we saw the effective rate of interest. I gave you this formula. E is equal to 1 plus I to the power n minus 1. And now for annuity payments, the future value of an annuity. That means every year I go on paying this amount of money. What will be the future value? The the future value is cash flow into 1 plus I to the power n. Right. Now please note that the annuity has certain rules, as I said. For a payment to be classified as an annuity, there will be 2 rules. Rule number 1 is the amount which is paid or received over this period of time should be constant. That is what I said. Cash flow, generic term. Annuity, the amount should be constant. Second is the time interval between every 2 payments, every consecutive payments should be the same. So if I receive a payment from bond, I am receiving interest on bond. And if I receive the interest every year in the month of March, it is an annuity. And the same amount, 7,000 I am receiving. But if I receive 7,000 rupees, 2020 I receive in August, 2021 I receive in January, 2022 I receive in December, 2023 I receive in September. So the time periods are not the same. The time gap is not the same. Right? In 1 year I am receiving in March, next year I am receiving in September, next year I am receiving in January, next year I am receiving in December. Doesn't make sense. It is going up and down. It is not constant. So the time gap between 2 successive payments is not the same. Therefore, dear friends, it is not an annuity. But if the amount of money is constant and you receive it at the same time every year, which means the time interval between 2 consecutive payments or receipts is identical, in that case, yes, it is an annuity. Now friends, 2 important points. Say I am receiving this money, right? And you know the financial year starts in April and continues till March. Okay, so if I am receiving this formula, please keep a note, right? Annuity is of 2 types, right? We will understand this. Just 2 minutes. You may receive, I was talking about this receipt of interest from bond, right? I have invested 1 lakh rupees in a company's bond, and bond is like preference shares, bond is like debenture. So they will pay me a fixed rate of interest, and the amount will come to me ideally in the same month every year. It is an annuity, of course, and of course it is going to be paid to me for the life of the bond. If the bond has a life of 5 years, well, I receive 7,000 rupees every year for a period of 5 years, and then the company will pay me the principal amount of 1 lakh rupees. This is how the bond works. This is how a debenture works. You have read about debenture, bonds, preference shares and equity shares in your accounts, also in your BCK. Now the question is, I might be receiving this interest, either in the month of April. So the financial year starts from April to March. The company might be paying me the bond interest in the beginning of the year. That means when time is equal to 0, t equal to 0. That means in the month of April, maybe on the first day of April, right? In that case, what happens? This type of annuity is known as annuity immediate or annuity due. So it is called, when I receive the money on the first day at the beginning of the year, right, in the first period, then this is called annuity due or annuity immediate. Please understand this and please keep a note of this. This is the first type of annuity. There are 2 types of annuity because as per the numericals, there are 2 assumptions, right? The assumption number 1 is that I will receive the money either at the end of the year, right? Or I receive the money at the beginning of the year, right? So annuity means 2 things, a fixed rate of payment over a period of time, number 1. Number 2 is what? The consecutive time gap, right, between 2 successive payments should be the same. So I am assuming that for this company's bond which I have purchased, the life is 5 years and it is 7% interest and the amount of investment is 1 lakh. So I will be getting 7% of 1 lakh, that is 7,000 every year. The question is that I might receive the money every year in the month of April on the first day of the year. In that case, it is called annuity due or annuity immediate. But if I receive the money at the end of every year, that means financial year 20, say I receive the money in March 2021. For financial year 21-22, I receive it at the end, that is on March 2022, at the end. So this was at the beginning, when time is equal to 0. But if I receive the money at the end of the financial year, the end of the period, P, or the end of the financial year, then this is called annuity. It is called annuity regular. Okay. So please note this. This is the second type of annuity. So annuity regular means the payment is received, the first payment of the receipt is received at the end of that particular period, at the end of the financial year, right? And if you receive the money at the very beginning of the financial year, at the very beginning of the accounting period, when time is equal to 0, when t is equal to 0, then it is called annuity due or annuity immediate. So two types of annuity. One is annuity regular, where you receive the money at the end of the period every year, and second is annuity due or annuity immediate, which means you receive the money almost like in advance. I mean at the beginning of the financial year, right? So that is called annuity due or annuity immediate. Okay. Now, sorry, but you have to remember two more formula. This chapter, as I said, is a long chapter, and you have to understand so many concepts, and you have to also remember quite a number of formula. But please note, I'll repeat once again, this chapter is the foundation of your CA. I might, as a chartered accountant, I'm not saying this as a maths faculty, but I'm saying this as a chartered accountant, that this chapter is so important as a chartered accountant's career, to a chartered accountant's career. If you do not understand this chapter, it's not a question of losing marks only. It is a question of losing serious, concepts while you become a chartered accountant. This chapter is the most important chapter relevant for a CA, because the entire world of finance, the entire world of risk management, the entire world of financial decision making, management accounting stands on this chapter. It is such an important chapter. That is why, thanks to ICAI for giving us 3 sessions only on time value of money, because there are new concepts, new ideas, new formula, new applications. So many things to learn, right? So for this annuity, 2 more formula. So you have seen what is annuity regular, and we have understood what is annuity immediate or annuity due. Now for annuity regular, the first payment will be received at the end of the period, at the end of every period. Now the formula for this, the future value of the annuity, the future value, please note, for annuity regular, I'm doing annuity regular first. For annuity regular, okay, the formula is A1 plus I to the power n minus 1 by I. Okay, once again, A is the payments made every year, the identical payments, because annuity means that the payments are all same. The amount of money paid is equal. So A into 1 plus I to the power n minus 1 by I. This is the formula we use for annuity regular. And for annuity immediate or annuity due, the same formula will be there, but you have to multiply it. So I'm writing same formula, ditto sign, multiplied by 1 plus I. I'll write it once again. I'm rubbing this formula. So once again, quick recap. Effective rate of interest we have done today, it is 1 plus I to the power n minus 1. For compounding, we know for compound interest, amount is equal to principal into 1 plus I to the power n, where I is the interest rate, n is the number of conversion periods. Third is, we have seen for an annuity, future value is equal to the cash flow into 1 plus I to the power n. Okay? I'm rubbing this part. And I'm writing the 2 formula so that you can once again note it. For annuity regular first, for annuity regular, the formula is future value is equal to A 1 plus I to the power n minus 1 by I. Right? Mathematical derivation is beyond the scope of our coverage. You have to remember the formula. Questions do come on this, and it's a very, very important part of our syllabus. Once again, I will just try to intimate you the importance of this chapter, right? As a chartered accountant, not just as a mathematics, faculty, which I am doing at the current moment, but more as a chartered accountant, very important for us. As a professional chartered accountant, let me tell you. This is first. So this is annuity regular. Now we go to annuity due or annuity immediate, right? The formula is future value is equal to A into 1 plus I to the power n minus 1 by I multiplied by 1 plus I. Okay, so you have to keep a note of these two formula. As I said, wherever there are shortcuts, I am trying to update you with the shortcuts, like the calculator shortcuts. I talked about the rule of 72, rule of 114, rule of 144, right? I also proved how the rule of 72 becomes handy and gives you an approximate result. For quick calculations, it may not be 100% accurate, but it is 95% accurate, right? It gives you quick answers for ready-made calculations. Okay. So annuity due, we have understood two types of annuities, annuity due and annuity regular. And if you see, this is part of 4.6.1, unit 4.6.1 of our study material, right? In fact, you will see table, there are two tables given to us. Table 4.4 in the study material, if you see, gives an example of annuity regular. So I'm writing annuity regular. And table 4.5, if you see, table 4.5 gives us an example of annuity due or annuity immediate, AI. So annuity regular is AR, annuity due is AD, or the other name is annuity immediate, so AI. Correct? So these are the two types of annuities. Okay. And I've also talked about future value. Let us go to, after this, let's go to unit 4.7. You will see unit 4.7. Page is 4.23 and 24. Right? Page 4.23 and page 4.24. You will see in the study material excellent coverage of this subject. Let me tell you, please go through the study material and read it as thoroughly as possible. That's why I'm referring each and every discussion. I'm referring to the study material, because that is like the Bible for us. It is like the Gita for us. It is like the Quran for us. It is like the main manual for us, right? Especially when you are actually undergoing mathematics. Study material gives you the most voluminous coverage of this topic. So please refer to each and every subsection of the study material. And in this chapter, page 4.23 and 4.24 refers to fair future value. Future value. Now, say for example, I have 1,000 rupees, 1,000 rupees, and I'm getting 7% interest per annum. So in 1 year, I'll be earning 7% of 1,000, which is 70 rupees. So my future value after 1 year becomes 1,070, 1070. Principal is 1,000, interest rate is 7%, the duration is 1 year. So applying the rule of simple interest, where interest is equal to principal into interest rate into time, I get 1070 as my amount, as my accumulated balance, also known as the future value. So today's 1,000 rupees is equivalent to 1,070 rupees, which I'll be getting after 1 year, provided the interest rate is 7%. Okay. And I have also looked at the formula. We have seen that the formula is very simple. Cash flow into 1 plus I to the power n, where the cash flow is the identical cash flows paid every year or received every year, and I is the interest rate and n is the duration, the number of conversion. Now we go to numerical examples on annuities and cash flows. So I'll wrap this up and go to the numericals, requesting you to move to page 4.24. Page number 4.24 of the Institute study material, please. Example 25. Example 25, 4.24. Okay. Please see the problem. 4.24 and example number 25. Okay. The question is, we are investing 3,000 rupees in a 2-year investment. So 3,000 rupees I'm writing, 3,000 rupees is my investment, and I'm investing it in 2 years. For 2 years, I'm investing it in a 2-year investment. So the time is 2 years. Okay, it's a 2-year investment. And what I would suggest is the interest rate, if you see, is 12%. Okay, the interest I is 12% per annum. So please note the problem. 3,000 rupees is investment, and it's for 2 years. It is 2 years, and the rate is 12%. The interest rate is 12%. Once again, please note the problem. We have to calculate the future value. So this is 4.24, page number 4.24, and we are looking at example 25. Right. So let us try and solve this problem. So we know that F is the future value, FV you can call it, and this is equal to what? This is equal to the future cash, this is future value is equal to the cash flow into 1 plus I to the power n. So please see this problem, that is 4.24, example 25, and let us work it out. So this is the first example we are doing on annuity future value. So cash flow we know is 3,000. So I write, in place of cash flow, I write 3,000. So 3,000. Interest is 12% per annum, and there is no need to change the interest rate here because there is no compounding. They have not talked about any compounding, not talked about quarterly compounding or half-yearly compounding. So the interest of 12% will remain as it is. Now 12% means 0.12, right? Because 12 by 100. 12% means 12 by 100, that is 0.12. So if you look at the problem now, it is cash flow 3,000 into 1 plus I, that is 0.12. Okay, and now they want to know the future value after 2 years. So we have written time, or n, or you can call it n. So n is equal to 2. So in place of n, it becomes 2. So the formula now reads 3,000 into 1.12 square. 1 plus 0.12 is 1.12 square. Let me quickly calculate with my mobile and just a moment. 1.12 square. So this gives me 3,000 into 1 point approximate, of course, 1.2544, and this is equal to rupees 3763.20. Okay. So the formula is future value is equal to cash flow into 1 plus I to the power n, and we know the value of I here, 12% is given, n is 2 years, so n is equal to 2, and by substituting the values of I and n and cash flow, the formula is set, and we have been able to achieve the answer, we have been able to arrive at the answer 3763.20. Okay. Now we go to another problem. This is from one of the old, past questions which came in the exam. Okay, let's take this question, and this is linked to annuities. Ravi invests rupees 5,000. Ravi invests rupees 5,000 in a 2-year investment that pays 12% per annum. Right? So what is the future value of the investment? It is identical to the last problem. We know future value is equal to cash flow into 1 plus I to the power n. Here I is 12%, that is 12 by 100, which means 0.12, number 1. I is, we found out, n is equal to 2. Therefore, putting these values back into the equation, we get fair value is equal to cash flow. Cash flow is 5,000 into 1 plus 0.12, 0.12 to the power 2. So this gives me 5,000 into 1.12 square, and this approximately comes to rupees 6272. So this is the future value, right? This is a past exam question which came in one of the CA foundation exam. Now we proceed to annuity regular, one numerical on annuity regular. Okay, this is, I think, fairly easy now, and you can see we have done, once again for a quick recap, we have done the the equivalent rate of interest, ERI and or EIR, the equivalent interest rate, right? And then we have also discussed in details about the type of annuities. We saw that annuity is a system of payment, cash outflow or cash inflow, cash payments or cash receipts, where the same amount of money is paid over a period of time every year, or the same amount of money is received every year. The only point is that the time gap, right, the duration between two successive payments, or in case of receipts, between two successive receipts, should be the same. That is what is called an annuity. I give the example of a bond. I have purchased a bond and I am getting an interest of 7% or 6%, and the life of the bond is 5 years. So for 5 years, I am getting an annuity payment, right? Now we go to annuity regular. We saw there are two types of annuities. Annuity regular is where you receive the cash payments or you pay the cash outflow at the end of the period. Year 1 at the end, year 2 at the end. That is called annuity regular. We saw the formula also. Formula is once again 1 plus I to the power n minus 1 by I multiplied by A, where A is the cash flow, right? And for annuity due or annuity immediate, it means that you receive the cash flows in advance. You receive the cash flows at the beginning of the year. You receive the cash receipts at the beginning of the period. Okay, that is when time is equal to t is equal to 0. Now we see an example. This is a past exam question, CA exam question. Find the future value of an annuity of 5,000. So let's apply the formula. The annuity amount is rupees 5,000, and it is made annually for 7 years. You have to find out the FV, future value. Okay. Annuity amount is 5 years, amount is 7,000, interest rate is 14%. Interest rate is 14% and it is compounded annually. Okay, it is compounded annually, and you are given, in the problem it is given 1.14 to the power 7 is 2.5023. This is given in the problem, right? Once again, let us review the problem. Once again, dear friends, note, this is an exam question. So I am trying to cover as many examples as possible from the study material, from the exercises, from the additional question bank, from the MTP, that is model test paper, and also from past exam questions of CA Foundation to make you get ready for the exams, and so that you become confident, you have knowledge, you have grip on the subject, the chapter. And once again, please do note, this chapter is of paramount importance, not only in mathematics, but also in your future role as a chartered accountant. Please keep that in mind. In this example, quick review, amount is 5,000, the cash flow is 5,000, duration is 7 years, interest rate is 14%, and it is compounded annually. So, the formula. Now, we know that the future value of the annuity, this is sort of an annuity regular. It is being assumed that the payment is made at the end of the period, because the question does not mention that you are receiving the money in advance or you are receiving the money when time equal to 0. It does not mention. Therefore, it is assumed to be an annuity regular, and here we can find out the annual payment is 5,000 rupees. I is equal to 14%, that is 14 by 100, that is 0.14. This is I. This is my rough sheet. This is my scratch pad. Okay, I is 0.14. A, that is the cash flow, is 5,000, and N is 7 years. Okay, N is 7. The formula we know is equal to A 1 plus I to the power n minus 1 by I. This is the formula. So let's fill up this formula to see what happens. So this is equal to A is 5000 into 1 plus I is 0.14. So 1 plus 0.14 to the power 7 because n is 7. So n is 7 minus 1 by 0.14 because I is 0.14 here, right? So this is the formula. Let's simplify this. 5000. 1 plus 0.14 is how much? 1.14. 1.14 to the power 7. But this is given in the problem. 1.14 to the power 7 is given. So I write 2.5023 minus 1 divided by 0.14. So now it becomes simple. If you calculate it, comes to, you can just quickly calculate. I'm not using my calci, just calculate it. I think it comes to around 553,654. Okay, something roughly around 53,653.57 or 6, something like this, approximate. I'm not using equal to sign, approximate. Right. So this is how we arrive at the solution to the problem. This is on annuity regular. Now we go to the last, I think the few last areas today, the present value, and this is a simple concept now. You have understood annuity, you have understood effective rate of interest, you have understood compound interest. So present value is cakewalk for you. Okay, now we know very simple example. I'll take 1,000 rupees. Keep it in a bank. Okay, bank pays me 6% interest. 1 year. Okay, so I get 1060. Fine, I get 1060. Now, this is simple interest. So I can say that today's 1,000 rupees is 1060 after 1 year. That means this is the present value and this is the future value. Can I say this? This 1060 is the future value of 1000. So this is for simple interest. Now we'll take compound interest. Okay? We take compound interest. Right? Please note we are doing unit 4.8 of the study material. Once again, please keep a track of the study material also as we go forward. 4.8. Now please note that the formula for compound interest we know A is equal to P into 1 plus I to the power n. Right? We also saw that the future value is equal to the cash flow into 1 plus I to the power n. Right? Or we can call it that the future value is equal to, let's put it in this way, is equal to the present value into 1 plus I to the power n. So, the present value is equal to how much? It is equal to A by 1 plus I to the power n. In case of future value, we were multiplying this part. This part, we were multiplying. But in case of present value, it will be the opposite, division. Okay, so if I say that, let's say it in this way, that 1,000 rupees, n is 2 for 2 years, compounding is done, and interest is 10%. Okay, what is the amount? So the amount will be P into 1 plus I to the power n, and here P is 1,000 into 1 plus I, so 1 plus I is 10%, 1 plus 0.1 square. So it is 1.21. 1.1 square is 1.21 into 1000, that is 1210. So, what is 1000 rupees today becomes 1210 rupees after 2 years. So I can say that the present value of 1210 is how much? 1210 divided by 1 plus 0.1 square. Please see if you understand. 1000 rupees multiplied by 1 plus I square gives you the future value. So the present value is what? The present value is future value divided by 1.1 to the power square. Right? This is the concept of present value and this is the formula. So it's just an interchange of the formula we have seen in the case of future value. It's just the opposite. Okay. So now we will take up, let's take a present value question, right? And we understand this. We have already seen number of formula today. First was the simple interest, then we saw the compound interest, then the third is the effective rate of interest or the equivalent rate of interest, whatever the effective rate of interest. Then we saw there was a separate formula for annuity regular and there was another formula for annuity due or annuity immediate. And now we have seen a formula for present value. Now we do a numerical on present value. So the question is, this is an exam question, not given in the study material. It's given in one of the exercises, not in the normal sections of the study material. The question is, what is the present value of rupees 100 to be received after 2 years? And compounding is done annually at 10%. So the present value we have to find out. Future value is given 100 rupees. The time, that is N, is 2 years. And the interest rate, interest I is equal to 10%, which means 10 by 100, that is 1 by 10, that is 0.01, 0.1, 10%. Okay, so we have to find out what is the present value. We know that present value is equal to A by 1 plus I to the power N. So A is 100 rupees, so 100 rupees divided by 1 plus I is 10%, so 10% is 0.1, 1.1 square. So this is 100 divided by 1.1 square is 1.1 into 1.1. You can use your calculator. 1.1 multiplied by equal to sign. So you will get 1.21 and this is around 82.64. Okay. So 82.64 rupees will ultimately become 100 rupees after 2 years if you do compounding on an annual basis and where the interest rate is 10%, right? So this is the concept of present value. Fine. Let me take up the last one, that is sinking fund, 4.9. So I'll change this, 4.9. Now the unit is 4.9 and this is perhaps the last point we are doing today in the chapter on time value of money, day 2, part 2. And after this, we complete this, we will move into the revision for the inequalities and we'll spend some time, it's almost 4 o'clock, but we'll spend some more time like we do on the other days and complete your queries and complete some of the other examples related to matrix, famous rule and determinants and inequalities. Okay. Sinking fund. What is sinking fund? You know, I'll start with this. You know there's a system in accounts and you've studied that. It is called depreciation. Now, in case of depreciation, what happens? A machine loses its operating capability, it becomes obsolete, it loses its working capacity and we write it off over a period of time. So, if I have a machine of 10,000 rupees, so the cost is 10,000 rupees and it has a life of 10 years and the scrap value is 1,000. Right, so what I do is depreciation is equal to 10,000, which is the cost, minus the scrap value, that is 1,000, divided by the number of years, 10. So 10,000 minus 1,000 is 9,000, by 10 is 900. So the depreciation per year is 900 rupees. This is the accounting part. You know accounting standard 6. AS6 you will find in your study material. This was the standard on depreciation. Now it is integrated with AS10. Fine. The question is depreciation a a cash expense? No. A company does not pay this 900 rupees in the form of cash. Okay, but what it does, what it does? It knows, the company knows that, well, this machine has a life of 10 years. So after 10 years, the machine will no longer be able to operate, right? The machine will lose its working power. I will not get any output from the machine. The machine will not help me in earning cash flow. So the machine will become useless. I will get only 1,000 rupees scrap value. So they know that, okay, they look at the time of 10 years. Okay, so what they do? They put 900 rupees, this 900 rupees every year in a sinking fund, in an account. 900 rupees, again next year 900 rupees, again next year 900 rupees. So that in 10 years time what will happen, this 900 rupees every year into 10 years, the company will be able to get 9,000 rupees as a fund. Plus they will get 1,000 rupees from scrap. So this 9,000 and 1,000 will give them 10,000 rupees. It is true that 10,000 rupees which they are going to get after 10 years at least will give them a financial support to buy a new machine. I hope you get this point. This is called sinking fund payment. Sinking fund payment means a fund where you put money. The fund is credited with a specified payment for a specific purpose. It can be for, say for example, many of you are staying in housing complexes. The housing complexes, you might be living in a housing complex with 100 apartments or 200 or 500 or 1,000. Whatever be the size of the apartments you have, your apartment owners association, if you see their accounts, you will find there is a sinking fund account where every year the housing, housing society or the cooperative housing society pays particular amount, the same amount every year, and credits that fund so that after a period of time, the fund can be used for painting of the house. It can be used for, say for example, for making some beautification in your apartment. It can be used for repair, for maintenance, for overhauling of your apartment, for a fresh coat of paint, as I said, for some new construction which they want to, say, a children's park they want to construct in the apartment, or they want to change the water filtration system. They want to change, they want to put in some firefighting equipment which needs money. So sinking fund is a type of such payment. In other words, sinking fund, I can say sinking fund. Sinking fund is a type of what? Sinking fund is a type where is a system of fund management where you are putting a specific amount of money for a specified duration for a specific purpose. So it is nothing but a type of annuity where you are paying. And the same formula will be used in case of sinking fund also. So let us see an example on sinking fund. Right, this is 4.9, unit 4.9 of our study material. Let us see a problem, and this is example 35 if you see in the sinking fund portion of our study material. The question is, how much amount is required to be invested every year so as to accumulate 3 lakh? Right? So, we want to accumulate an amount of 3 lakh rupees and the duration given is 10 years. So, I want to achieve a corpus. See, we use the term corpus. Corpus means a collection. Okay. Corpus means fund accumulated. Like you see for the COVID-19, you have the PM Care Fund. You have the state government's care fund. People are putting money into it. Right? So many institutions, many corporate bodies are paying and creating a corpus, a collection. So the sinking fund is a corpus, right? We are putting money into the corpus specifically for accumulating it such that we can use it for painting, for maintenance, for repair, for operation. Here in the problem, the amount we want to accumulate is 3 lakh rupees and the duration is 10 years. That means we want to accumulate a fund of 3 lakh rupees after 10 years, and the interest is compounded annually. So the interest is annual compounding and the rate is given 10% annual compounding. Okay, so we have got all the data necessary for solving this problem. This is example 35 of the study material. Please go through it. So the formula is very simple. We have seen the annuity formula, the annuity regular formula. Once again, I am writing the formula. Okay. So we know A 1 plus I to the power n minus 1 by I. This is the formula, right? So let us see whether we can fill up the blanks, right? I'm using the black pen now. So this is equal to A is we don't know because A is what we have to find out. So A is we don't know. I'm writing A. 1 plus I to the power n. So 1 plus I is 10%. 10% means 10 by 100. That is 1 by 10. That is 0.1. Okay. So I write 1 plus 0.1. N is 10 years. Okay. N is 10 years. So to the power 10. Minus 1 divided by I, and I is 0.1. So again 0.1. This is equal to 3 lakhs. So 3 lakh. 300,000. 3 lakh. So if you simplify, it comes to like this. A into 1.1, that is 1.1 to the power 10 minus 1 divided by 0.1 is equal to 3 lakhs. So if you use a calculator, you will arrive at A will be somewhere around, I think, 18,832 approximately. So this through compounding over 10 years, right, at 10% will ultimately provide 3 lakhs as per the formula. 1 plus I to the power n minus 1 by I. Okay. So this is the annuity which we have done, and I'm taking another example from the exam. So this is from the study material, example 35, and the section is 4.9 sinking fund. I'm doing another problem on it's a past question which came in the exam, CA exam, foundation exam, and this is regarding the future value regarding annuity regular. Okay, so let us just do this problem. So we are actually dealing with the same formula, A 1 plus I to the power n minus 1 by I. Okay, the question is, rupees 2000 is invested at the end of each month. Please see the wording, 2000 rupees invested at the end of each month. End of each month in an account paying interest at the rate of 6% per year compounded monthly. Be very careful with this. So the compounding is done monthly. So compounding is done monthly. Please note the points. What is the future value of this annuity after the 10th payment? Okay. Now they have given you, it's given in the problem 1.005 to the power 10 is equal to 1.0511. I request you to note the problem along with me. This is an exam problem, past exam problem which came in the CA Foundation exam. 2000 rupees is invested at the end of each month. So the hint is given. End of each month. Every month, 30th of Jan, 30th of Feb, 29th, 28th of Feb, 30th of March, 31st of March, 30th of April. So at the end of each month. Right? End of the month, end of the period means we know it is an example of annuity regular. Right? If it had been at the beginning of the month, then it would have been annuity due or annuity immediate. So this is an example of annuity regular. So we have end of each month. So this is the hint number 1. Hint. Shortcut. You know this is annuity regular because they are saying at the end of each month. Right. 6% is given, but it is compounded monthly. Be very careful. Please, like a chartered accountant. You know, you see our institute motto, Ya Esha Sukteshu Jagriti. And you know the logo of our institute. The logo for chartered accountants is the eagle. Always remember, eagle has sharp eyes, eagle has vision, eagle is alert, eagle is sharp. Be sharp like that. Always. So, if you are sharp enough, you will see it is compounding monthly. So, the hint is given. So, interest is 6%, compounded monthly. So, 6% for 12 months. So, I need to know the interest for 1 month. What is the interest for 1 month? So, it is 6% by 12. So, if you simplify, 6% is 0.06. Divided by 12, you get 0.005. Be very careful. 0.005. This is the monthly interest. Because it is compounded monthly, you have to be very careful with this. It's an exam question. So please pay attention and please note the different steps. Right? I hope you can see. I always explain in a dynamic way, not a static template, not a static slide. You will not understand anything. I can show you the ready-made solution. It will not make head and it will just be useless. Waste of time, I feel. This is the way to learn mathematics, especially for most of you who are new to the subject, and the formula are not easy. This chapter is not easy. That's why 3 days. It's a very important chapter. So ready-made solution, ready-made, everything, laid in front of you in a platter. No, it will not work. So this is the way to break down, analyze, note the hints, do the working notes, do the step-by-step calculation, then arrive at the final answer. That is the way. So you have here 6% compounding. This means 0.005. The formula is simple. You have seen the formula A into 1 plus I to the power n minus 1 by I. Fine. So here we know that A is equal to 2000 because every month, at the end of every month, 2000 rupees is paid. So 2000 I write into 1 plus I to the power n. So 1 plus I is now 0.005. So 1 plus 0.005 to the power n. Right. So do we know n? 10th payment. N is given. N is 10. So n is the 10th payment. So n is 10. Okay. So after 10 months basically. So here after 10 months, 10 payments here means 10 months. Okay. So basically every month the compounding is done 10 payments. So 10th payment 10 months basically. Right. So to the power 10 minus 1 by I. I is 0.005. Please note it. No mistakes. Be accurate. Be confident. So this if you break down now 1 plus 0.005, this part is already given. Okay. So I simplify this. 2000, 1 plus 0.005 to the power 10 is given. 1.0511 minus 1 divided by 0.005. So it comes down, if you do, it comes to 2000 is 2000 into this portion. 1.0511 minus 1 by 0.005. This portion comes to 10.22. So this amount is rupees 2000 into 10.22. It comes to 20,440. 20,440 is the answer. Okay. So 20,440 will be the ultimate future value on the 10th payment. Right. We have done present value calculation, and with this sinking fund is done. Okay, I will take one last example from page 4.19 before moving on to the revision part. Okay, so I request you to note the example number. Example number 23 of the study material, page is 4.19. Right. The question is, find the amount of compound interest. So we have to find the compound interest and the effective rate of interest, right? The equivalent rate, equivalent rate or effective rate of interest. If an amount of 20,000, so P is 20,000, 20,000 rupees is deposited in a bank for 1 year, and the interest rate is 8%, but it is compounded semi-annually. So compounding is done semi-annually, right? So this is the problem. We need to solve it. So let us see the question. 20,000 rupees, semi-annual compounding, interest rate is given 8%, and you have to find out the compound interest and the effective rate of interest. Now here the question is, be very careful, because here 8% is the annual rate of interest. So 8% means 0.08. I think this is clear. Since it is semi-annual, we have to find out the annual interest rate is, we know, 8%, 0.08. But semi-annual, okay, the period is now 6 months. Semi-annual will be 8 by 2. That is 0.08 by 2. That is 0.04. Okay. So let us find out what is the compound interest. We know the compound interest, basically the formula is what? P into 1 plus I to the power n, right? Here we know that this is the amount, of course. Compound interest means, I mean to say, the amount is this, right? So let us find out the amount. Amount will be equal to, P is 20,000. So I'm writing 20,000. 1 plus I is 0.04, and n. So here the question, let's once again go to the question. The question is 1 year, right? So 1 year. So n will be 2, because it's semi-annual compounding, so n is 2. Semi-annual is 6 months. Duration is 1 year, means 12 months. So n will be 12 by 2, 12 by 6, that is 2. N is 2. So n square. This means 20,000 into 1 plus 0.04 is 1.04 square into 1.04. Let's work it out, right? It will give you, just work it out. So it's going to give you 1.0816. So into 1.0816. So this will be the total amount. But I want only the interest. Okay. So the interest will be what? We know P into 1 plus I to the power n minus P. So this will be 20,000 into 1.0816 minus 1. So you will get the interest is 20,000 into 0.0816. This 0.0816, right? And this we will get at 1632. 1632 is the amount. So the interest amount is 1,632. 1632. If this is the interest amount, then we have got the first part. So the compound interest is rupees 1632. The formula is clear. P 1 plus I to the power n. We have got P is 20,000. I is 8%, but it's for the full year. We need to find out the semi-annual interest. So it is 0.04, because 8 by 2, 0.08 by 2. So 1 plus 0.04 square. So this gives us the amount 20,000 into 1.0816. But we need to find only the compound interest. So we deduct the principal. I'm just going step by step. You can of course make it a little shorter, but for understanding purpose, let's go step by step. So this is how we achieve the interest of 20,000 into 1.0816 minus 1. That gives you 20,000 into 0.0816, that is 1,632. So the first part is done. Now we go to the second part. The second part is the effective rate of interest, right? So the effective rate of interest is equal to 1 plus I to the power n minus 1 by I. 1 plus I to the power n minus 1 only. So in this case, what we do is we have I, we have already got I. So this is 1 plus I is 0.004. 1 plus 0.04 to the power n. So n is 2 square minus 1. So 1 plus 0.04 square minus 1, because the formula is 1 plus I to the power n minus 1. So this gives me 1 plus 0.04 square minus 1. It eventually works out to 0.0816, that is 8.16%. 0.0816 equivalent is 8.16%. So the effective rate of interest is 8.16%, and we have seen the compound interest comes to 1632 rupees 1632. Okay, so I think this is almost 4:25 now. So let's stop here. So far as the questions of the time value of money is concerned, a quick recap. We have seen a recap of the first day. We looked at what is simple interest, why interest is paid, discussed about inflation, liquidity preference. We also discussed about what is the financial impact of inflation on the purchasing power, right? We moved on to discuss about the equivalent, the effective rate of interest, the ERI or the EIR, the effective interest rate or the effective rate of interest, which is basically the equivalent interest over the full year, but what I get when there is a compounding done, right? We did numericals on the effective interest rate, effective rate of interest, and we proceeded to understand cash flows in terms of FV, that is future value, and we looked at annuity in detail. We have two types of annuity: annuity regular, where the payments are taking place at the end of the period, and we have annuity due or annuity immediate, where the payments are taking place in the beginning of the period. So we looked at both the types of annuities, and there are two formula we observed both the formulas, and we did numericals on that. Then we moved on to the present value calculation, which we did number of numericals from the study material as well as from the exams. And last but not the least, we moved on to sinking fund, and I did a numerical from the example. And finally, we are summing this up with some problems we have done from the past exam questions which has come in the Institute's CA Foundation exam. So with that, we come to the end of this part. I will now move on to take some of the queries, and we will do a quick revision of another maybe max to max 15 minutes. We'll focus on the matrices and the Cramer's rule and the inequalities, right? So those who want to stay with us, do stay with us, and let's continue. So I'm now taking up revision on the inequalities, right? So we have some questions. Yes, Rajal Gupta from Kanpur, yes, explaining linear inequalities. Request has come from Rajal Gupta. I'm taking it up. Palak Agarwal has asked, sir, in determinants, when will the equations be consistent and inconsistent? She is from West Bengal. Palak, I'll answer your question. I'll do a sort of a numerical where you will see inconsistent set of equations. Vanshika from Punjab, sir, please clarify what is skew symmetric matrix and symmetric matrix. Vanshika, I explained it in detail. Skew symmetric and of course symmetric matrix and skew symmetric matrix on 11th of July session. I'll do it once again today. Yuvraj Soni has said the time value of money is very interesting. I was so excited to attend the class. Thank you. Soumya Jaiswal, linear inequalities. He has requested me to take up one more question. I'll take up. Anushka, how to remember formulas. Anushka Khernar from Nasik. How to remember formulas? Well, you have to practice. To more practice, you can remember. Akshita is asking, where is the question bank? Now, Akshita from Punjab, please note, Akshita, that the question banks are given at the end of many of the chapters in your study material, and you can download the MTPs, the model test paper from the Institute website. I also gave you the website ICAI CDS, where you can also order past years, the study material, the updated study material, the study kit, and you may be getting some past year questions also. Yashika Dhawan from Delhi, can you please tell me the shortcut of calculator? Yashika, I have done it today. I'm sure you have observed, you have noted down. Tina from Punjab has asked, from where, sir, can we download previous year's question papers? As I said, previous year's question papers may be available from the ICAI online sales, that is ICAI-CDS.org. Now we are from Delhi. If we get the answer as 3.9 and the option has 4, is it correct to tick 4 as an option? Yes. If the answer is 3.9, one of the option is 4, provided it is the nearest option. So in the exam, you try to answer the nearest answer, the closest answer possible, nearest and closest. Right. Palak Agarwal, are we allowed to use calculator? Palak, I have already said yes, and I have also discussed, the calculator has to be a non-scientific calculator, normal 12-digit non-scientific calculator. I have also talked about the shortcuts. I hope you have listened. Saqib Baraza Taji from Nagpur has given his registration number and said, I am a CA Foundation new student. Help me in preparing for the subjects. My request to him is please follow the VCC ICAI CA Tube YouTube channel and please go through the study materials and the MTP. I am sure you will do well in all the papers of the exam. Also, questions have come from Utkarsh. He has said splendid teaching. Thank you, Utkarsh. Siddhant Khan and Switi Kumari from Ranchi. They have talked about after how many points after the decimal should we work. So I think 2 places after decimal is reasonable. Max to max 3 places after decimal. Siddharth Khajanchi from Bikaner, in case of conversion of matrix, quarterly to yearly, I think I have answered that. Sanskriti from Nagpur, meaning of compute. Sanskriti, the meaning of computation is to calculate, to find, to determine, to work out. Okay, then we have Annapurna from Chennai thanking me and Sneha from UP. She has asked, sir, what about effective rate of interest? Sneha from UP, I think Sneha, you have learned today what is effective rate of interest. I have done it in detail. Isabella Anthony again thanking me for making the concepts clear. Welcome Isabella. Then we have Supriya Saha. One more graphical problem on linear inequalities. I am doing it now. And Sakshi, I must acknowledge some others. Subiksha from Tirunelveli. Kirtana from Chennai. Arnab Bajaj, I have already taken Arnab's question earlier. And Sakshi, then Pratham Shah, Vishakha Agarwal from Goa, Ahmedabad and Delhi respectively. So they have appreciated the teaching and they said that they are able to understand. Thank you. Thanks to all of you. Marilyn Maria Jose from Pondi also has said that she is able to follow. Thanks. Mageshwari S has said whether normal or scientific calculator. Well, you know it's a normal calculator. Navneet from Haryana. Adjoint matrix and adjoint and cofactor. Yes, I'll once again explain it. Jyoti Singh has also said that, sir, thank you. So, welcome Jyoti. Poonam from Dehradun, what is the use of e-journal? Well, I said that e-journal of the institute is very important. Please download it from the website. Many times, especially I'll request you to go through the May. I'll write it for you. The May issue of the e-journal. May 2020 issue. Please download it. You will be surprised to see that it contains many questions on time value of money. May 2020 ICAI e-journal. Of course, for the students. You will see many questions are there on the time value of money. Very, very important. See, this is why we are here. We are not just here to give you theory and, coming here, looking at the watch, solving and going and saying bye-bye. No, it's a waste of time. It's to guide you. Question is to guide you. Question is to give you additional knowledge. I have to give you additional links. I must share additional information so that it helps you. Because CA is not just your maths exam. It is not just foundation. You have intermediate, IPCC, you have final. Okay, so long way to go, long journey. So you need this support. That's why I'm sharing. Thanks to Poonam for asking this. Poonam is from Dehradun. Right. Okay. So now let's go to quick examples. I'll first take, I must also acknowledge all these friends who have taken time to write to me. And unless I do it, I think the session is not complete. And I must respect the time they put in the queries. And I'm trying to revert back to the queries to the best of my ability and keeping a tab on the time also. I'll take Unit 1, some questions from the study material Unit 1, exercise number 8 and page 2.24 on equations. Quickly, I'll do number of problems and this is number 8. Problem number 8. Please note it's 4:30. I'm doing it after the allotted time. We have completed today's quota, today's share of the TVM. time value of money. After satisfactorily completing, we are going to the additional areas, right? The question is the hypotenuse of a right-angled triangle. Right-angled triangle. Hypotenuse of a right-angled triangle is 20 centimeter and the difference between its other two sides is 4 centimeter. The difference is 4 centimeter. What are the sides, right? So let one side is x. So the other side is x plus 4 because the difference is 4 centimeter. Okay. And it is given that the hypotenuse is 20 centimeter. So if the sides are x and x plus 4 in a right angled triangle, you know the rule. The formula is x square, one side square plus the other side square, x plus 4 whole square is equal to 20 square. That is side square plus side square is hypotenuse square. Hypotenuse square. So this means x square plus x plus 4 whole square is x square plus 8x plus 16 is equal to 20 into 20. 20 square is 400. So you get 2x square plus 8x plus 16 minus 400 is 0. So you get 2x square plus 8x minus 384 is 0. If you divide by 2, you get x square plus 4x minus 192 is 0. I think we are correct so far. Now, this can be subdivided, broken, split. It's a quadratic equation. We did some sessions back. So x square plus 16x minus 12x minus 192 equal to 0. So this gives us x plus 16, x minus 12 equal to 0. Which means either x is equal to minus 16 or x is equal to 12. My question to all of you, can x be minus 16? Can the side of a triangle be negative? No. So the answer is x is 12. If x is 12, then the other one is x plus 4. So the other one is 12 plus 4, that is 16 centimeter. So the answer is 12 centimeter and 16 centimeter. Right? I hope this is done and clear. Okay, now we go quickly to matrices. I am doing miscellaneous problems and helping you with as much of inputs and support as possible. Okay, so we will do a matrix. The matrix is like this. X plus 3, x plus 3. Then we have minus 1. Here we have 4 and here we have 5. This is equal to 6 y, z minus 3 and 5. We have to find the value of x, y and z. Once again, let us have a look. X plus 3 minus 1, 4, 5. This matrix is equal to 6 y, z minus 3 and 5. We have to find the value of x, y and z. You know, if it is an equal matrix, two relations, the order must be same. Now in this matrix, the order is 2 by 2. So 2 into 2. This matrix is also 2 by 2. And each corresponding element must be equal. So since it is given that matrix A is equal to matrix B, so we can easily write x plus 3 equal to 6. So the equation is x plus 3 equal to 6. Okay, equation 1, which means x is equal to 6 minus 3, that is 3. Done. Next is, second element is minus 1. This matrix second element is y. So the equation number 2 is y is equal to minus 1. We have got it. Equation number 3. Here we have 4. Here we have z minus 3. So equating them, z minus 3 is equal to 4. That means z is equal to 4 plus 3, that is 7. Okay, so this is an exam question. It came in CA Foundation earlier. Right, let me move to matrix multiplication now. Quickly a revision. Many of you have requested me to do matrix multiplication. Once again, I am taking it from one of the exam questions. Okay, hope you are there with me and continuing even after the allotted time. And that is fun of mathematics once you start doing it. If you find the session interesting, if you find the stuff being discussed is interesting, you continue doing it. That is most important. And the more you do mathematics, the more you work out, you become faster in your application, quick thinking, reflex becomes sharp, and your accuracy level goes up. So put together the confidence, build up your confidence, right? So now we do matrix multiplication. A is given 153, 153, 4, 5, 6. A is a matrix. Please note, how many rows are there? 2 rows. How many columns? 3 columns. So it is a 2 by 3. B, matrix B. The matrix is 5, 3, 1, 0, 2, 8. Okay. Many of you have requested me to do matrix multiplication. I am requesting those of you to please note step by step. Okay. Again, I am working out with you. No solution in front of me. And not giving you ready-made solution slide and all, which is useless. Okay, just a time pass. This is the way to learn the steps. Okay, so A and B are given, right? A and B are given. Please note that it is a 2 by 3 matrix. B is, the number of rows are 3, but the number of columns is 2, 3 into 2. Always please remember that in case of matrix multiplication, the number of columns, right, in first matrix must be equal to the number of rows here in the second matrix. Otherwise, it's not possible, right? So let us do the multiplication. So AB will be equal to how much? So AB is equal to, let's see the solution. So 1 into 5. Please do very carefully. 1 into 5. 1 into 5 plus 5 into 1 plus 5 into 1. Plus 5 into 1 plus 3 into 2. So we are going row wise and this side we are going column wise. Plus 3 into 2. This is the first expression. Now we will take 1 into 3. So 1 into 3 plus 5 into 0. 5 into 0 plus 3 into 8. 3 into 8. Now we go to the second row. So 4 into 5. 4 into 5 plus 5 into 1. 5 into 1 plus 6 into 2. 6 into 2. Now we take row number 2 and column number 2. So 4 into 3. 4 into 3 plus 5 into 0. 5 into 0. Right? Just check, let me check whether I am correct. 1 into 5 we have done. 1 into this, 1 into 3, yes. 5 into 0 and 3 into 8. Just checking. Yes, 3 into 8. Okay. So now we have 4 into 3 plus 5 into 0 plus 6 into 8 plus 6 into 8. Okay. Now let us simplify. So AB is a very complicated and any time you may make a mistake. That's why I paused and checked so that I must make sure whether I'm writing correct or not. You're doing fast and even one mistake, one wrong number means the entire matrix calculation will go totally haywire. Okay. So here we have 1 into 5 is 5 plus 5 into 1 is 5 plus 3 into 2 is 6. Okay. Then we have 4 into 5 is 20 plus 5 into 1 is 5 plus 6 into 2 is 12. This one let us take 1 into 3 is 3 plus 5 into 0 is 0 plus 3 into 8 is 24. And we have 4 into 3 is 12 plus 5 into 0 is 0 plus 6 into 8 is 48. So the matrix becomes, the product becomes 5 plus 5 is 10, 10 and 6 is 16. 3 plus 0 plus 24, that gives me 3 plus 24, that is 27. 20 plus 5 plus 12, so it is 25 and 12 is 37. And we have 12 plus 0 plus 48, that is 12 plus 48, which is 60. Okay, so 60. This is the matrix multiplication. We have done it correctly, right? So row versus column 1, row 1 versus column 1, this one. Row 1 versus column 2, row 2 versus column 1, this one. Row 2 versus column 2, this one. Right? I hope this is clear. Right. let me directly now go to symmetric matrix. Once again, I think I explained symmetric matrix means a matrix which is a square matrix and where the transpose, the matrix is equal to the transpose. As simple as that. In case of symmetric and skew symmetric, the matrix A is equal to matrix A transpose. If transpose we have done. And skew symmetric means, okay, what is skew symmetric? Skew symmetric means the transpose of a matrix is equal to minus A. The transpose of the matrix gives you the negative of the matrix. This is skew symmetric. Okay, let me go to now directly to, I'll take inequalities. Okay, let me take the first one. This is, so a lot of things we are doing. Additionally, exercise, 3A, exercise 8, 3A, page 3.13 of the study material, number 2. Okay. Right. So page 3.13 and number 2. The question is on the average, experienced person does 5 units of work. So experienced person does 5 units of work while a fresh person does 3 units of work. A fresh person does 3 units of work. Just make it 3. Does 3 units of work. Right, but the employer has to maintain an output of at least 30 units of work per day. Minimum 30 units of work per day. So how to express this situation as an inequality? Okay, so a experienced person is doing 5 units of work in a day and a fresh person is doing 3 units of work in a day. Now, so we have to maintain 30 units. So question is, if we say that if 5 units is being done per day, right? So 5 units is being done per day, and if he is working for X, if you consider X as the number of units, which is experienced person is working, and Y as the number of units which the fresher is working. So you can say that the total output has to be at least 30 units. So, ideally 5x plus 3y should be at least equal to, that means it should be equal to or more. So greater than equal to 30, this is number 1. And definitely x and y need to be, x need to be greater than 0, y need to be greater than 0 because they have to be positive. This is the unit of work. So it cannot be negative or it cannot be 0 then because everybody has to work. So this is the optimization for this particular problem. Now let me take up the last one on graphical method. So I'll take this up. Possibly we'll end with that today. I'm taking up linear inequalities and let me take example number 7. Okay, this is 3x plus y is less than 6. So we are trying to graphically plot this. 3x plus y is less than 6. Right. So now what we do is, I was discussing the last day that first of all you have to set x is equal to 0 and then set y equal to 0. So first we say 3x plus y is equal to 6. The inequality is 3x plus y is less than 6. We have to graphically plot it. So we have to use graph. Now for finding the coordinates of x and y, let us assume 3x plus y is equal to 6. So we need a box here, x and y. So when x is 0, when x is 0, 3 into 0, so y becomes 6. Y becomes 6. And when y is 0, then 3x becomes 6. So x becomes 2. So when y is 0, x becomes 2. Okay, so we get the coordinates of the equation like this. Of course, you can also add one more value. Say if x is, of course, for this equation, for the equation 3x plus y is less than 6. for x equal to 1, y equal to 1, this relation will be correct. Okay, for x equal to 1, y equal to 1, it will be 3 into 1 plus 1. So 3 plus 1, 4. 4 is less than 6. So it will be correct. But we have got x is 0 and y is 6, x is 2 and y is 0. So let us try to plot it. I'm just trying to draw a straight line. Just draw it once again. Drawing a straight line here. Okay. This is 0 point. You know this is the x-axis, this is the y-axis, and we are going to first plot x is 0, y is 6. So x is 0, no movement on this side, y is 6. So 1, 2, 3, 4, 5, 6. This point is 0, 6. Like a GPS, okay, GPS coordinate, 0, 6. Okay. Then we take 2 and 0. So 2 and 0 means 1 and 2. Positive side because x is plus 2. 2 and no movement on the y-axis. 2 and 0. So this point we can say is 2 and 0. So we pass a straight line like these 2 points now, coordinates. So like this. Approximately. Okay. Line. Okay. This line is representing, now this line represents 3x plus y equal to 6. Okay, so now we have plotted the line here and we have got the points here. So the equation is 3x plus y is less than 6. We know less than means to the left and more than means to the right. So if this is the line, less than means this side, more than means upper side, upper right hand. So we will move towards the lower left hand. Okay, it's a slanting line. Okay, later on you will study differential calculus. We'll discuss about the slope of a line. This is left hand to the lower side. So the shaded region, I am shading the region now. So the left hand lower portion. This is the solution of the line 3x plus y is less than 6. Okay. So friends, it's almost 4:50 now. So with this, I think we complete today. There are a number of other examples. Hope to do it on some later date. So we have looked at quick revision of day 1 of time value of money. We have discussed about many examples. Once again, went through the economics part, inflation, demand, and we talked about why interest is paid. Right, then we moved on to the effective rate of interest. We learned about the annuity, 2 types of annuity, annuity regular, where the payment is made at the end of the period, and annuity due or annuity immediate, where the payment is made at the beginning of the period, right, when time is 0. After that, we moved on to future value and we saw the cash flow formula, the cash flow into 1 plus I to the power n. From there, we computed a number of examples on present value. After that, we went into sinking fund problem and I saw a number of problems relating to the exams which have come in the exam. After that, we stopped there insofar as time value of money is concerned and we moved on to the repetition, of course I'll call it, but it's a revision of the matrices. So we looked at once again symmetric matrix, skew symmetric matrix, equality of matrix. I did a quadratic equation solution. Plus we looked into another important aspect, and that is we looked at the multiplication of 2 matrices, 3 by 2 and 2 by 3. After that, we took up the last example when it comes to 2 examples I have taken on inequality. One is with regard to the working pressure and the experienced workers, the optimization problem, and finally we looked at how to solve graphically inequality, and we took the inequality 3x plus y is less than 6. And that's how we brought out the shaded region. If there was another relation, we would have plotted it, and together we will find the common areas and we will plot that part, we'll shade that part which satisfies both the inequalities or both the inequations given, right? So with that, dear friends, we come to the end. Do send in your queries and hope to meet you again, same time, after 2 days. Till then, stay safe. Practice the problems, go through the study material, go through the VCC, the videos uploaded in YouTube, and take care. Bye-bye and see you soon.